You're welcome back. In this video, we will look at the first requirement of this question, which is to prepare the journal entries to record the above transactions. The transactions that happened during the year were: 1. The partnership agreed to admit B, who was to bring a cash of 25,000 into the firm. That's the first transaction. And the next transaction is the revaluation of these assets: buildings, fittings, inventory, trade receivables, and finally goodwill. But I need you to understand something about goodwill. This goodwill only arises because of the revaluation of the old business. Okay? They revalued all the assets and liabilities. So the new value of the old business is now higher than the net assets of the business, of the partnership. That was what gave rise to goodwill. Goodwill, we will not show it in the books. The goodwill will be shared between the partners. The goodwill will always be shared among the partners. Note that you will see how we will treat the goodwill when we get to the goodwill account. Now, let's go to the first transaction, which is the capital introduced by the new partner, B. For the capital introduced, we will debit the cash or bank account in the journal with 25,000, and we will credit the capital account of B with 25,000. That's the double entry for that. Now let's go straight to the revaluation. Firstly, the building was revalued to 55,000. The old value was 51,000 in the statement of financial position. You will see that the new value is higher than the carrying amount by 4,000. That 4,000 is a revaluation surplus. Such surplus, the double entry will be to debit the buildings account with 4,000, and we will credit the revaluation surplus account with 4,000. Okay, that is that. The next revaluation was fittings. It was revalued to 27,000, while the old value was 29,000. Now, the new value is lower than the carrying amount by 2,000. This is a revaluation deficit. The double entry for that is we will debit revaluation deficit with 2,000, and we will credit the fittings account with 2,000 to bring down the value to 27,000. Okay. The next is inventory. The revalued amount is 15,500, while the carrying amount in the statement of financial position was 16,000. This is also a revaluation deficit, so we will debit revaluation deficit account with 500, and we will credit the inventory account with 500. And finally is the trade receivables. The revalued amount is 4,800, while the carrying amount is 500. This is also a revaluation deficit, so we will debit the revaluation deficit account with 200, and we will credit the trade receivables account with 200. So those were the transactions that occurred during the period. The goodwill, like I said, will not be recorded in the books of account, but rather it will be shared among the old partners in their old sharing ratio, and thereafter it will be shared among the new partners in the new profit sharing ratio. You will understand why in the next solution. In the next video, we'll be looking at the second requirement of this question, which is to prepare a revaluation account and a goodwill account. So thank you very much. See you in the next video.